Dear students, we are about to kickstart the day 3 of the revision session for the financial reporting. Today's target is the interpretation and analysis, and then we are going to attack the consolidation adjustments, and finally we are going to attack the cash flow statement. Okay, so this is the agenda for the day. We will proceed like we will have a 45 to 50 minute session. We're going to have a 10 minutes break. We will again proceed another 50 to 45 minute session. Then we're going to have the break and we will have the final session. So this revision session will be divided into 3 sections, and we will be attacking 3 topics here. Okay, so let's begin with the first one. We have selected questions from the ACCA. The ACCA hub has really good challenging questions here. So we will first of all attack the quizzes relating to the topic, and then we're going to look at the practice questions. Okay, so let's begin with this one. Uh, the first question that we have, Marple has a current ratio of 2:1. Which of the following transaction will cause the current ratio to decrease? Okay, so we look at these various options and see which actually would reduce the current ratio, okay, or decrease the current ratio. So the question is, which of the following transactions will cause the current ratio to decrease? The current situation is 2:1. It could be regarded as 200 to 100. The current assets would be 200 and the liabilities would be 100, or we could call it. So this is the current situation. Okay, so let's see if we move on from this point. We look at the first one. Receives cash in respect of a long-term loan. So what happens is that we have received cash, money has come in, and that would increase the current assets. And this money has come in because we took out a long-term loan. So the long-term loan is not going to have any impact on the current ratio because the current ratio has the current assets and the current liabilities. The long-term loan is a non-current liability. So clearly, when only the assets are increasing, the current ratio is going to increase with first option. Okay, whereas if we look at the second one, we have received cash in respect of a short-term loan. So we have taken out a short-term loan. Taking out a short-term loan would mean that there would be an increase in the liabilities, the current liabilities, and there would be an increase in cash as well. The issue here is that the current situation is not equal. The current situation is different. It is that the the assets are double the size of liabilities. So if we just take this question to the Excel sheet and try to see the impact of this second option, we will have a better understanding to it. Okay, so let's see how we can approach this one here. So let me just clear the drawings for you first. This is the first question. Let's see how we can understand this and look at the impact that this adjustment is going to take. So here's the question. Let's see what is the challenge here. So I'm looking at option B here. I am considering the current situation. So here we have this the option B. We are going to understand the option B. We right now have the current ratio is 2:1. So this means that if I say the current assets, if I say that the current assets are 200 and the current liabilities are half the size. So let's see, but this is the current situation, okay? Uh, from the question, okay? This is the data. So if we have a short-term loan, a loan, we can say a short-term loan. The short-term loan comes in, and if we say the short-term loan is only 50, so assuming if the short-term loan is 50, we add 50 to the current asset, and we add 50 to the current liabilities, and now the new state is 250 and 150. Okay, if this is the case, then we need to calculate the current ratio again. So based on this situation, we have the current ratio. The current ratio till this point was 2:1, and if we look at the situation here, we are going to put it general. If the current ratio is 2:1, so that is the current situation. I could just write it 2:1 because the Excel is changing things. So this is the starting point. So now after this adjustment, if we look at the new situation, the assets have become 250 and the liabilities have become 150. So if I just take 250 divided by 150, so the answer is 1.67. Okay, so now we would say it is 1.67 ratio 1. So what does this mean? That with taking out a short-term loan, the current ratio has actually decreased. At the start, the current ratio was 2:1, but as I incorporated these changes, I said that if there is a short-term loan of $50, and the liabilities would also increase by 50. This is the increase in cash. This is the increase in liabilities. So the new situation of the current assets would be 250. The new situation of the current liability would be 150. And if I calculate the current ratio on this basis, the answer would be 1.67 ratio 1. So this is actually a reduction in the current ratio. Okay, so this shows that option B shows that it reduces or it decreases your current ratio. Okay, so I hope this second point is clear. If you just simply look at this thing, so it would mean that there is going to be no impact. There is an increase in liability, there is an increase in cash. But when you calculate the values based on the starting point, because the starting point is not equal, the starting point is different. So the end result is different. Okay, excellent. So we move on to the next one now. Pays an existing creditor. So if we pay a creditor, so what happens is that your liabilities, your current liabilities go down and your current assets also go down. So that is not going to make an impact. We are going to pay the current liabilities or the payables through the cash. So this is not going to have any impact. And if we look at the option D, writes off an existing trade receivables against the loss allowance for trade receivables. Now this is very important, that if any receivable is already considered doubtful, so it is already present in the allowance. Okay, so writing it off now would not have any impact. Okay, because this was already treated as an allowance. Fine, so this would, option D, would have no impact at all. The irrecoverable debt that we have just written off was already part of the allowance for the trade receivables. Fine, so we need to disregard option D as well, and the option that actually reduces the current ratio is option B. So I hope this makes sense. This was it looked a very innocent question, but it had this trick of option B. Yes, students, I hope we are comfortable with this one.
Yes, sir. Thank you.
Excellent. So we move on to the next one here. Let's take the right answer here. We say that option B is correct here, as we have discussed. Moving on to the next one here. This is about a not-for-profit entity Let's see which of the following about a not-for-profit entity is valid. So if you're looking at a business which is not for profit, which point would be valid related to that? Okay. The first one is there is no requirement to calculate an EPS. So the famous EPS that we just concluded yesterday has come up again. So there's no need to calculate an EPS figure as it is not likely to have shareholders who need to assess its earnings performance. So that is true because the not-for-profit entities are not companies, okay, and they do not have shares. And if they do not have shares, the EPS would not make any sense. So they say which of the following about not-for-profit entity is valid? That is true because for a not-for-profit entity, there is no need to calculate an EPS since there are no shareholders. Okay, let's look at the other points as well. The current value of its PPE, property, plant, and equipment, is not relevant as it is not a commercial entity. Now, this is not correct because not for profit entities also have PPE, also have property, plant, and equipment, and these are very valuable items for any entity, whether it's a profit making or a not for profit. Okay, because the property, plant, and equipment does not come cheap. The buildings, the property, the equipment, these could be in the ownership of a not for profit entity, so they are very important for them. It is not irrelevant, they are quite relevant. So this statement is not correct. We are looking for valid statement for not for profit. Moving on to the next one, interpretation of its financial performance using ratio analysis is meaningless. Again, this is not correct. The not for profit entities have to be more vigilant. The issue is that when you're looking at a not for profit entity, they have limited resources. And the problem with their resources is that if they are spent, they stay spent. The money does not come back. Whereas in a profit making entity, if you spend money, you earn more. Okay. If you are investing in something, you're actually doing it for a profit. But when it comes to not for profit entity, there is no profit, and you have to be very vigilant about their financial performance. That how are they performing? Are they efficient? Are their operations loss making or profit making? Okay. So this is very important. The performance is, I would say more important than a profit-making organization. That they should not be inefficient. They should not be wasting anything. Okay, their expenses should be in control. So this is not valid for a not-for-profit. Okay, we are looking for valid points. They say it's meaningless, but it's not meaningless. It's quite meaningful. If you look at the option D, its financial statements will not be closely scrutinized as it does not have any investors. Again, the financial statements will be closely scrutinized because either the government is going to be supporting it, and or the donors are going to support it. So it will be scrutinized. Okay, they're just not going to throw away their money. There are audits carried out in the not-for-profit entities for any financial loss or any inefficiency. So only the first statement is valid. The other three statements are not valid. Okay, like they also scrutinize their financial statements. They look out for better financial performance, and to them, the property, plant, and equipment is quite important. So option A is valid out of the four options. I hope this makes sense for you people.
Yes, sir. Yes,
Yes,
sir.
sir, it does.
Okay, that's good. So moving on to the next one here, we have this. Which of the following will reduce the length of company's working capital cycle? Now, when it comes to working capital cycle, we need to understand what is working capital cycle. The working capital cycle is your current assets and your current liabilities. Okay. So when you have increase in inventory, increase in receivables, so that actually lengthens your working capital, because the inventory rises, your money is stuck. Okay. When the receivables are not paying you the money, then your working capital cycle is long. Okay. So we're looking at something that would actually reduce the length of the working capital. Fine. And when you are settling your payables early, that is also a problem for working capital, because when we take extra time from our suppliers, that gives us some freedom and we have some cash. Okay, you need to understand this point, that you need to quickly sell your inventory, you need to quickly recover money from your customers, but you need to make your payables, make your suppliers wait for their money. Okay, you do not pay them early. If you pay them early, you pay all the cash, and then you are in a problematic situation. So this is the basic idea. Now if we look at what will reduce the length of the working capital cycle, so the first one is the thing that I was just explaining, reducing the payables payment period. Reducing the payables payment period is not a good thing. It is going to create a problem. Okay, because if the payables are higher, that is going to help our working capital. Okay, because working capital is related to cash. If we have settled the payables early, then we will run out of cash. Okay, and if we haven't paid them, it means we have the enough cash to support the working capital. So this is not the one to reduce the length of the working capital. Option one is not the answer, because reducing payables is not going to help the working capital. Okay, it is going to lengthen the working capital. Increasing the inventory holding period, again, holding inventory is going to be problematic, because when you're holding inventory for a longer period of time, you're not getting any cash. Your working capital stretches, it becomes longer, it increases, it does not reduce. Allowing customers extra time to pay, again, when you allow your customers extra time, which means your receivables are increasing, that is not good. You need to get money from them quickly. The last one, speeding up the production process. If your production process is fast, it means that your inventory will be available quickly. You're going to have less time converting the raw materials to work in progress to finished products. And if this is the case, this is going to reduce your inventory holding period. So option D is the correct answer. Okay. Yes, people, I hope the explanation is making sense to you people.
Yes, it does. Thank you, sir.
Very good. Welcome. So we move on to the next one. This is option D. This is the correct answer. So I move on.
Hello, sir.
Yes, please.
Yeah, sorry, can we go? Is it possible we can go back, or it's?
Huh?
Is it possible we can go back? Because the option D, I was thinking that maybe I'm just thinking too much. That what is the guarantee that the production process, the inventory after production, will be
Yeah.
sold quickly? Because once it's still in stock, so there wasn't any. It wasn't really clear. The answer wasn't really clear as
Okay. Okay.
to.
Yeah. Yeah.
Yeah, so I was a
I
bit.
could just explain it for you, and then you can let me know. We can always come back to the. Basically, we just have to do two more questions, then we can review the quizzes. This is, there is no going back.
Oh,
However, I will just explain it to you.
that's fine. That's all right. Thank you.
When you are working on inventory, you're not looking at only finished good, you are looking at the raw materials, and the raw materials are going to be going to take less time. You are processing them quickly. So what happens is that your the inventory holding period becomes less. And when your inventory holding period becomes less, the cost and the cash flow and the cash stuck into it is released earlier. Okay, you can sell the inventory quickly, so that actually reduces your working capital cycle.
All right, all right, all right. Thank you.
No worries. Okay, so we look at this last, second last one. The quiz is here. We have to calculate the ROS, return on capital employed, and the information that we have is that this an extract from Lencia Statement of Financial Position is as follows. We have the share capital, the revaluation surplus, the retained earnings, the loan notes. So this is actually your capital employed, your equity, and your non-current liability. So this is the denominator for the ROS, and then you have the information for the numerator, which is the operating profit. So we have Lencia had profit before income tax of 122,000 and an income tax expense of 36,000. Okay, the only interest expense relate to the loan notes which have been in issue throughout the year. Okay, so we have this profit before tax, and we have deducted the income, the interest value. However, we need the operating profit. So to calculate the operating profit, there is this line: the only interest expense related to the loan notes which have been in issue throughout the year. So this is the information related to the loan notes. So we take 200 multiply by 8%, we will have the loan note interest. I believe that it will be beneficial if we take this question to the Excel sheet and I solve it for you. So let's see how we can attack this one. Okay, so we have this okay, so we have this ROS is equal to your operating profit divided by your capital employed multiplied by 100. We have this operating profit. We have this operating profit can be achieved if we have this 122,000 of the profit before tax. We add back, because it is deducted, the interest. So the interest is 200,000 multiplied by 8%. So if we add this thing, we will have the operating profit figure. So let's see what is the interest, which is 200,000 into 0.08, that is 16,000. So we take 122,000 plus the 16,000, that is 138,000, and the capital employed, it is easy, it is provided here, which is the equity is 275, the loan note is 200, so the total capital employed is 4,75,000. We divide these two figures and we multiply this to 100 and we'll get the answer. Okay, so let's see, 138 divided by 475 multiplied by 100, that is going to give us the answer. These figures are rounded. Let me unround it. So that is the final answer. So the percentage, the ROS is 29.1%. So we do not have the option D. Option D is the correct one. So I hope this one is clear before we move to the question section to click the right answer. You need
Why are we calculating? Oh, sorry. Why are we calculating 8% of the 200,000?
Because
And adding it to
the only interest expense relate to loan notes. The value of the loan notes are 200,000 and the interest on loan note is 8%. So we multiply this 200,000 into 8%. Okay. I hope this
But
makes
sir, how will I know that I'm supposed to add the interest
the thing
to
is,
the operating
but you
profit.
see, what is this thing in the formula? It is the operating profit. What is operating profit? Operating profit is profit for the finance and tax. Okay, this is the operating profit. The figure that is provided in the question is profit. The figure available is profit before income tax. Okay, income tax expense. And what do we need? Do we need the same thing? Do we need the profit before income tax? No. The answer is that we need profit before finance and income tax. This is what we need. I hope you get the idea. So it means that the interest is deducted from this figure. So if we add back the interest, which I've just done here, the interest is 200,000 into 8%. I added this to the operating profit to calculate the operating profit. Okay. Actually, I was trying to calculate the operating profit, so that's why I wrote operating profit. However, this is the formula to calculate the operating profit. Okay.
So, sir, when calculating ROIs, we're supposed to use the profit after tax and interest over the capital
No.
employed.
We need to have profit before. You see, I've given you the formula. The formula for the operating profit is profit before finance and income tax. The figure that we are provided in the question is profit before income tax expense. So we need to calculate the finance cost and we need to add it back.
Okay.
So I'm adding the 16,000 interest, which is 200,000 into 8%. I hope this is clear now.
Yes, it is. Thank you.
Excellent. Yes, I hope everyone is comfortable with this one.
Yes, sir.
If you're all comfortable, so we could just quickly go and see option D. It is 29.1, which we have just calculated. Okay, so moving on to the next one here. This is the last of the quizzes. We have this, let's see. Which of the following is a possible reason why a company's inventory holding period decreases? So the only reason the inventory holding period would decrease from 1 year to the next is that we somehow get rid of the inventory quickly. Okay, so how will this happen? Number one is seasonal fluctuation in customers' orders. Now this is something that is normal every year. The seasonal fluctuations would be the same in 1 year to the next. It won't have any impact. Do you understand? The seasonal fluctuations that are present in this year would also be there in the previous year. Do you agree?
Yes, sir.
Yeah, the seasonal fluctuations would be the same every year. So they won't create an impact. They won't result in the inventory holding period decreasing. Okay. Discounted selling price. What will happen to the sale of the inventory if we reduce the prices? Any ideas?
Inventory will sell fast.
Exactly, the inventory will sell fast, and we will have a decrease in the inventory holding period, and that is the final answer. Okay. However, we are going to look at the option C and D. We reduce the selling price, the people are going to come and buy the products quickly, and we are going to have to hold inventory for a lesser period. That will result in a decrease in inventory holding period. Obsolete inventory lines. The inventory is old, it's not selling. So what will happen? The inventory holding period is going to be very long. Does it make sense? The inventory holding period will be long. So this really is not going to make sense. Is it clear?
Yes, sir. Thank you.
Excellent. The last one is a fall in demand for its products. The inventory is not selling because there is no demand. The customers do not like our product. So what is going to happen? Will the inventory holding period increase or decrease? Yes, people, kindly update me. Obviously, this is going to increase your inventory holding period. So the correct answer is option B. Okay.
Yes, sir.
Excellent. So I'm moving on to the results here, and I see we have, yeah. So these are the quizzes that we have just done. These are the 5 related to the interpretation and analysis. So we've got them all right. I hope you're comfortable with these.
Yes, sir.
Excellent, excellent. So we now quickly move on to the practice questions relating to this chapter, which is chapter 26. Let's see, let's attack them right away. We have 10 more questions to deal with in this section. So here we have this first one. Let's understand. We have the requirement. Which of the following factors could account for the shortfall? There is a shortfall here. An entity that fixes prices by adding 50% to cost actually achieved a markup of 45%. When you add a percentage to your cost, that is regarded as a markup. The normal position is that we add markup to the cost and we add 50%. But for this period or in this situation, we could not achieve the 50% markup and we ended up having a lower markup of 45%. So this is regarded as a shortfall. So the question is, which of the following factors could account for the shortfall? Number one, you see, the sales were lower than expected. You see, these sales do not have an impact because this is about the selling price. If we were able to, or if they say the sales were lower, which means that we sold less products. Okay, this has got nothing to do with the fact that we were able to charge a lesser selling price. The problem here is that since we usually have 50% markup, but this time we had 45% markup, this means that we were able to charge a lesser selling price. But here we only sold fewer goods. Sales were lower than expected, but we thought that we would be selling this many products. We could not achieve that. Okay, so this has got nothing to do with the margin. You need to understand the situation. I hope this makes sense. Okay.
Yeah.
Okay. So here we have this the option B. The opening inventories had been overstated. When the opening inventories are overstated, this would actually mean that your cost became higher. There was some problem, some mistake that the opening inventory was a higher figure. And if the opening inventory is higher, this means that the cost is going to increase. And with the increased cost, we're going to have lesser, profit. Fine. We thought that we might achieve the 50% markup, but we only achieved 45%. So this is the reason. Why? Because there was an error when we were costing the products. We ended up making a mistake and we overstated some of the inventory more than its value. So due to this error, we would have a shortfall. Okay, so option B seems to be the right answer. Let's look at the other things. The closing inventories were higher than the opening inventories. Fine. You see, the closing inventories are the items that are not sold. When they are not sold, they're not in the selling price and they're not in the cost of sales. You see, the closing inventories are deducted from your cost of sales and they are not in the cost of sales and they're also not in the sales. So they create no impact. Okay. So if they were higher, it is only the number of units. This would not make any difference. I hope you get the idea. This is talking about the number of units sold. So if we are comfortable with the first three options, we move to the last one. The purchases were higher than expected. So it is not the cost of purchases. It is again referring to the number of items that were bought. We were able to buy more products than we expected. So the effect would be cancelled out by higher closing inventory. If we purchased more but we did not sell more, we would have a higher closing inventory figure. Is it clear? So that really is not going to make any impact. The only impact is going to be this error that we did, that we overstated the opening inventory, and opening inventory is part of the cost of sales. We had a higher cost of sales because of an error, and that resulted in achievement of a lower markup. So the answer is B here. Okay. So
I think this particular question, sorry to interrupt, this particular question is a bit confusing. I don't know. I want to take a screenshot and then later post it on the page for. I don't know whether I could have a further
no
explanation
problem.
on it
No
because
problem.
it seems a
You
bit
can tell me. You can
confusing.
tell me what is the issue here. Like
Yeah.
I would like to explain again that the sales were lower. This is talking about the number of units sold. The closing inventories were higher, which means that we were not able to sell a lot of products. So we ended up having a lot of products in the inventory. The purchases were higher. Clearly, if the purchases are higher, we were not able to sell a lot of products, then clearly that would be regarded as the closing inventory. A higher purchases and a higher closing inventory means that there were less sales, less number of units sold. But here in option B, we look at that the opening inventory is a higher figure. It is not because of the number of units in the opening inventory. It is due to an error that the opening inventory was regarded or written as a higher value than it should have been. So that resulted in a higher cost of sales. And when the cost of sales is higher, you have a lesser margin. Okay. On top of it, if you look at this figure, you will also see that when the closing inventories are higher, your cost of sales is low. Okay. Because a bigger amount is deducted from cost of sales. Is it clear?
Yeah, noted.
I hope
Thank you.
it makes sense now.
Yeah, it's all right now. Thank you.
Excellent. So this is the first one. So we've got the option B as the right answer. Let me just clear the drawings before we move on. Okay, the next one that we have. This is another theoretical question. You see, this section is more of a theory. Which two of the following factors could cause a company's gross profit percentage on sales to fall below the expected level? So it's a similar question. We have two factors that would end up causing the gross profit percentage on sales to fall. Okay. Number one is the understatement. We ended up reducing the value of closing inventory due to some problem. The closing inventory was not what it should have been. So if the closing inventory is a low figure, this will result in a higher cost of sales, and a high cost of sales would lead to a lower gross profit figure, okay, or the lower gross profit percentage. You see, when the closing inventory is less, the cost of sales becomes higher, and when the cost of sales is higher, the gross profit percentage will fall. So one of the options is A. Remember, we are looking at two options. So since the closing inventory is less, the cost of sales will be higher, the gross profit percentage will be low. The second option is the incorrect inclusion in purchases of invoices relating to goods received in the following period. We have not received any products. We received them in the next period, but we recorded them in the current period. We incorrectly included them in current year, so that would increase the cost of sales. When the cost of sales is high, the gross profit to sales percentage is going to go down. So that is another reason why your gross profit to sales will fall. Okay. And these were the two that we were required. Let's look at the other two as well. The inclusion in sales of the proceeds of non-current assets. This, when you sell a non-current asset, this is not supposed to come in sales. But when it comes to sales, the sales figure swells up. The sales figures become higher. And when the sales figure is higher, the gross profit percentage to sales is a higher figure. Okay? Because the gross profit is sales less cost of sales. So if the sales is high, because an item was mistakenly added to it, because the sale of the non-current asset is not included in revenue. So when it is included in revenue incorrectly, it increases the sales and it results in a higher gross profit figure, and the gross profit to sales percent is expected to increase. Okay, so this is not the right answer. The last one is trade discount offered to customers were lower than expected. So you see, the trade discount that is offered to customers was lower. So what would this mean? Would that make any impact? The customers were given less trade discount, so which means that the sales revenue is likely to be higher, and when the sales is high, the gross profit percentage would also be high. So the last two would actually result in a higher gross profit percentage to sales figure. Yes, people, I hope this makes sense. From here, we could conclude that option A and option B are the correct figures.
Yes, sir, it makes sense. Thank you.
Okay, excellent. So we move on to the next one here. Okay, so the next one is, we have this, now this one is a bit tricky. I will take this to Excel to explain it to you. Identify by clicking on the relevant box in the table below how these misstatements affect the calculation of government's current ratio and inventory holding period. So we're looking at two ratios for this business. Due to these misstatements, there are two misstatements as well. One of the misstatement is that first they tell us the current ratio. The current ratio has been calculated as 1.2:1. However, it has been discovered that the closing inventory has been understated. One issue, that the closing inventory is understated by 24,000, and the opening inventory has been overstated by 24,000. So these are the two issues, right? So due to this thing, you need to understand what goes in the current ratio. Does the closing inventory go in the current ratio or the opening inventory? The closing inventory goes to the current ratio. So if the closing inventory that goes to the current ratio is a low figure, it is understated. So what will this lead to? This will lead to an understated current ratio. I hope this is clear. This is the easier part. Yes, students, I hope this makes sense. That is the first impact. The closing inventory goes to the current ratio because the current assets divided by current liabilities. So in the current assets, we have the closing inventory, which is understated. So that would lead to an understated current ratio. On the other hand, when we look at the inventory holding period, so the inventory holding period is calculated by the your average inventory. So when we take the average here, the closing inventory is less, the opening inventory is high. So this is not going to make any impact. Do you understand that the average inventory holding period, we use the average inventory. So when we add a lesser closing inventory figure and a higher opening inventory figure and we divide by 2, this is not going to have an impact on the average inventory, but the inventory holding period is the mix of two things: the cost of sales and the average inventory. Okay, so the cost of sales is going to have an impact. The cost of sales. Let's see what is going to happen to cost of sales. Your opening inventory is high, your closing inventory is less. This would lead to a higher cost of sales. Let's take this question to the Excel to have a better, deeper understanding. The first part is easy to understand. However, the later one is a bit technical one. So let's paste the question here and then address this issue. Here we go. Okay, I hope we are comfortable with the impact on current ratio. Yes, people, and understated at the closing inventory that goes to the current assets is understated. Okay. Yes, people, I hope this is fine. If you tell me this, then I will go on.
Yes, sir, you can go on.
So we now focus on the next one. The next issue is the that is related to your inventory holding period. So if you look at the formula for the inventory holding period, what is the formula? That is the average inventory divided by your cost of sales multiplied by 365. So now, as I say, the average inventory will be unaffected. Okay, I hope you understand why. Because the opening inventory is high and closing inventory is lesser by 24,000. So this really is not going to have an impact by 24,000. Fine. But when it comes to the calculation of cost of sales, however, the cost of sales will be an overstated figure. Why? Because the opening inventory, which is overstated. The opening inventory is overstated, add purchases and less the closing inventory. The item that is deducted is understated. So this will lead to a higher and overstated figure of cost of sales. This is what I mentioned here. The cost of sales will be overstated. Now, what is cost of sales? Cost of sales is the denominator here. When the cost of sales is going to be higher, what is going to happen here? The inventory holding period is also going to be understated. I just students, do you agree?
So we processing, but I think personally I'm a bit confused because you see, cost of sales is the opening our purchases and then less closing stock.
Yeah, the opening inventory plus purchases plus closing inventory. Your opening inventory is incorrectly increased by 24,000. That will increase your cost of sales. And the item that reduces your cost of sales is closing inventory, and that is reduced. So something that is going to reduce your cost of sales is understated. It is less.
All right. Yeah.
Do you get the idea now?
Yeah.
Excellent. So what happens is your cost of sales, you lead to a higher cost of sales figure, and that is going to lead to an the understated opening inventory, the overstated opening inventory and understated closing inventory. So that is going to lead us to this that we will have both the understated inventory holding period, because the denominator is going to be a higher figure. This will lead to a lower this would lead to a lower inventory holding figure, okay, an understated one. So if we go back and see, the current ratio will be understated and the inventory holding period would also be understated. Okay, so this one, as I said in the start, is a bit tricky. No
Yeah,
impact.
but where I got a little bit confused is that they all have the same amount. So I thought maybe there wouldn't be any effect.
Yeah, they, in one aspect, they did not create any impact. I wrote it here that this one, the average inventory will be unaffected, because the average inventory is opening inventory plus closing inventory divided by 2.
Yeah,
So
yeah.
that is cancelled out, but that is not going to happen in cost of sales. An overstated cost of sales, an overstated opening inventory would lead to a higher cost of sales, and an understated closing inventory would further increase the cost of sales. Okay, so we could say that the cost of sales will be overstated by 48,000. Is it clear?
Yes.
That's the issue. Okay. So we move on to the next one from here. There we go. Okay, now students, we have to make a call here. Should we continue with these questions or should we stop it here? We take our break and then we start with the consolidation adjustments. What do you say? Should we continue or should we take a break here? Or because we will be sacrificing the time for the other questions. Okay, anyway, let's get done with this one. This seems to be a numerical question. We haven't attacked much of the numerical questions, then we can decide. Okay, so what is the ROS, return on capital employed? We've already done a question related to that. So the formula is your operating profit divided by the capital employed. The capital employed is your equity plus your non-current liability. So let's see the information. The following are extracts from the financial statements of Lamas for the year ended 31st of December 20x2. We have the statement of profit and loss, and we have the statement of financial position. From this, we get the operating profit. So this is the figure that we need. The figure before the interest expense and before the taxes. So we're going to take this figure and we're going to divide this with the equity plus debt, which is your capital employed. So we simply do this thing. So can you people do the math for me? 795 divided by 4,000 multiply by 100. What is the answer that you get? We have to get it to one decimal place. 795.
19.8.
19.8.
19.8. 19.8.
Yeah, 19.9. So that's very good. That was easy. That's why I told that we could. So that is 19.9. So that is the right answer. Okay. That was easy because we have already done with the ROS. Okay. So moving on quickly to the next question. I hope we are fine. This was easy. Is
Yes,
everyone
sir.
okay? Excellent. Okay, moving on to this next one. This is a good, challenging question. So let's attack this one. I think we haven't attacked such a question. This requires us to find the receivables average receivables correction period, and this also wants us to find the gross profit percentage, and this is the information given. I would like to take this question straight to the Excel and then solve it there because it's a totally numerical question. Let me just clear the drawings before pasting it here. Okay, so it's a really good question, and I believe you people are having a good time in doing these questions. You're understanding them better. Okay, so here we go. We have this Belvin buys and sells a single product. The following is an extract from its statement of financial position. We have the inventories. This is the figures for 20x6 is going to be opening, and this would be closing. So we need to have this receivables collection period. So opening inventory is there, the closing inventory is there, opening receivables are there, closing receivables are there. We have sales and purchases. The sales are 200,000, the purchases are 120,000, and 20% of the sales were for cash, which means the credit sales are 80%. Okay. So if we consider this information, we say that we're trying to calculate the average receivables collection period. So that would be your average receivables. Average receivables divided by your credit sales. That is important to remember, multiply by 365. So let's quickly deal with the average receivables. The average receivables are the average receivables. Yes, can someone do the math for me here for average receivables? This is the receivables are 16 plus 24. That gives me 40. Divided by 2 is 20. And my credit sales would be it is 200 multiplied by 80% because 20% is cash sales. So there I get the 160. So I've got 20 average receivables days divided by credit sales, and I multiply this to 365. I get the answer. That is 20 divided by 160 multiplied by 365. The answer is 46. If I unround it, that is, yeah, rounded, it is the 46 days. So this is one of the part done. Now I'll quickly move to the GP, the gross profit percentage. So when it comes to the gross profit percentage, we need to have the GP, and we divide this by sales, multiply by 100. We already have the sales, but we do not have the gross profit. So what is GP? GP is equal to your sales, which is 200,000. Let's show cost of sales. Now, cost of sales is opening inventory. The opening inventory is 40. We say 40,000 plus we take the purchases are 120,000, and we take away the closing inventory, which is 50,000. Yes. So what is the cost of sales figure? So we have sales 200,000. The cost of sales figure, yes, it is 160 minus 50. It is 110. So that is 90. Okay, you people are giving me the answers. I did not get the chance. So yes, that is good. The cost of sales is going to be yes. What is the gross profit? That means the cost of sales is 110, but the gross profit is 90, and I have the sales with me. The sales is 200. I hope I'm doing the calculation right, and I multiply that to 100. I should get my answer. Okay, so that is 160 minus 50. That is 110. I take away, deduct it from sales. That is 90. So let's calculate the value. 90 divided by 200 multiplied by 100. The answer is 45%. So what is this? The 46 days and 45%. That makes it option D. I hope this is clear.
So, the receivables is trade receivables over revenue.
Credit
So
sales.
if it was
Not revenue, but the
credit sales, yes, sir.
Yeah.
Credit sales, yes, sir. So if it was just receivables collection period, we wouldn't average, like do that divided by 2. It would just be
This
normal.
is, you see, look at the name here, what they have referred. This is average receivables collection period. This is not normal receivables collection period. Do you understand?
Yeah. Okay.
Okay.
No, I get it. Yeah.
So I hope you're comfortable now.
Yeah.
So the correct option is D. So let's quickly check the D option. That is the right answer. Okay. So students, do we make a pause here, and after the break attack the next topic, which is the consolidated adjustments?
Yes, sir.
Yeah, there are other questions, but I would leave those questions to you people because we have other topics in the agenda. So I hope this is good. Yes, can we take a break now?
Yes, please.
Okay, so this is the break.
Yes, we can.
Dear students, we are now looking at this second section of the this third day of the revision, and we're looking at consolidation adjustments. So let's start without any delay so that we could use best use of the time. So here we go. This is the first one, the first question in front of us. This okay, so we have this. Let me just okay, so let's look at this first question and then understand. I hope all of you are with me now. Okay, what purchase consideration should be included in Huge's statement of financial position in respect of its investment in small? Answer in dollar in the answer box. So whatever the value is, we have to calculate it here. And let's see what is the situation. We are looking at the purchase consideration. Okay, so Huge acquired 60% of Small's 500,000 shares. The purchase consideration consisted of an immediate cash payment of 3.45 dollars per share that have been acquired. So the 500,000 into 6 would be the 60% would be 300,000. So 300,000 multiplied by 3.45 is the immediate cash plus a share exchange of 3 shares in Huge. So they will get 3 shares for every 2 shares in Small. And at the date of acquisition, the market price of each share in Huge and each share in Small was 6.5 and 4.2. However, we are only considering 6.5 because Huge is issuing its shares. Okay, so let's take this question to the Excel sheet and attack it so that we could understand. So we will have a new Excel sheet for this new set of questions. Let's clear the drawings as well. Okay, so here we go. So we have this. Okay. Let's see if we could do this one. Anyway, I could just add a new sheet here, which we can see. Okay. Just a second, the Excel is not responding to me. Let me just close all the windows first, and then we can see. Okay. This is your, okay. So students, we have this question here, which we just saw. There is this company, we simply have to find the purchase consideration. Let's see. Some of the purchase consideration is cash based and the other one is share based. So let's see. The cash part of the consideration is going to be total number of shares were 500,000. We acquired 60%, and the dollar value is 3.45. This is the amount of money that we have paid. So let's first of all calculate the number of shares, which is 300,000. So we take the 300,000 multiplied by 3.45. This is the amount of cash that they have paid, and then there is this the shares portion. So we have these 300,000 shares, and for every 2 share of the shares of small, we will give 3 shares of huge, and then we multiply this to the share price of huge, which is 6.5. Okay, so I will read the requirement again here. It says that plus a share exchange of 3 shares in huge for every 2 shares in small. So we have acquired 300,000 shares in small. So we divide 300,000 by 2, which I did here, which will be 150. So 150 multiplied by 3 would be 450, and then 450 multiplied by 6.5 is going to be the answer. So 450,000 shares into the share price of huge, because we're introducing the shares of huge. This would be the total consideration. Total consideration to acquire small. That is what huge is going to pay. So let's find this value. And the answer is 3960. I hope this is clear.
Yes, sir.
Okay, excellent. So that was easy, I believe, not a complicated one. So we can just go and write the answers. So here we go. That is the answer is 3960. So that is 3960. Let's confirm it. Yeah, we should have written the 3 zeros. We calculated the figure here. It is 3.96 million or 3,960,000, right? So we need to add 3 more zeros. Otherwise, the answer is fine. I hope this is clear. We can move on to the next one.
Yes, it's clear.
Okay, excellent. So let's look at this next one. This is a good question, a good conceptual question, which let's see the requirement here. The requirement is that, yeah, which 2 of the following items should Tom include in the fair value of the identifiable net assets of Jerry when calculating goodwill in accordance with IFRS 3? So this is very important. It can create trouble for students at times. So let's see. And we're looking for 2 items. Tom has purchased all the share capital of Jerry. And what are the items which we need to see? A contingent liability resulting from a present obligation, which may result in an outflow of economic benefit. So it is a contingent liability for Jerry, but when Tom is going to acquire it, Tom is going to consider this as an actual liability, and a liability will be considered. So this is one of the items. Remember this point that whenever we are doing the or we are calculating the goodwill, any liability which is a contingent liability, we will treat it as a normal liability. So this is going to be there when we see the fair value of the identifiable net assets. The second one, a provision required to cover the costs of reorganizing Jerry's departments to fit in with Tom's structure. So this is something that is post-acquisition. Later on, when Tom has acquired Jerry, and then some reorganization will take place. So that is something that will be after the takeover. Okay. So right now we do not need to recognize any of this. We at the date of acquisition we look at the net assets at that specific date. So we're not going to consider this one. A warranty provision in Jerry's financial statements to cover the potential repair costs relating to goods sold. So this is a warranty provision that you see when Jerry sells products, so he commits to the potential repair costs relating to the goods sold. If any good has any problem, so Jerry will do the repair. So this would be included because Jerry has sold those goods, and if anything comes up, so this would be regarded as a liability when calculating the value of the net assets at the date of acquisition. The last one, goodwill included in Jerry's statement of financial position. This related to an unincorporated business that Jerry had acquired 8 years ago. So whenever you deal with such a thing, any goodwill in the subsidiary company's financial statements is ignored. Okay, so we're not going to consider this one. Any goodwill amount would not be considered as the fair value of the identifiable net asset. So we're going to ignore the second because it's a post-acquisition item, and this is a rule that we do not consider any goodwill that is in the subsidiary's net assets. So that makes it option A. Let's quickly take them answer A and C. So these are the two items that would need to be considered, and these are the correct answers. So I hope this is clear. We can move on to the next one. This was a good question to remember which items would be considered as the net assets. Yes, people, I hope you're with me.
Yes, sir.
Okay, excellent. So let's clear the drawings here. Moving on to the next one. This is another one, similar question. Identify by clicking on the relevant box in the table below which provisions may be included in the consolidated statement of financial position in accordance with IFRS 3. Now here, we are not considering goodwill. We are considering what would be recorded in the consolidated statement of financial position in accordance with IFRS 3. However, the items would be similar, but the time period is different here. The financial statements of Tiny include a provision for reorganization. The reorganization is underway, and the provision is to cover the costs to be incurred in the next 6 months to complete the reorganization. Huge is considering acquiring Tiny. If it does so, the reorganization of Tiny will continue. Now, this is something which is already going on. The reorganization is being taken place, and whether they acquire Tiny or not, the reorganization would continue. Okay, so this is something for which a provision has to be included. So we would go for the inclusion of this, the provision for reorganization, since this is not something that will take place after the acquisition. It is already underway. We look at the next one. In assessing the fair value of the net assets of Tiny, the directors of Huge wish to make a provision for future trading losses and include the existing provision for reorganization cost. Okay, so here the future trading losses haven't taken place. Okay, so this is going to be considered when the trading losses take place. Okay, we cannot create the provision here. Okay, so we are not going to include it, we're going to exclude it. I hope this one makes sense, that the reorganization cost is included because the reorganization is already underway, and this has got nothing to do with the acquisition of Tiny. If they acquire Tiny, they will reorganize. If they do not acquire Tiny, they will still carry on their reorganization. And the trading losses haven't taken place. So when they take place, we will consider their provision. Okay. So I hope this is clear. Yes, please.
I don't know the difference. The last question, we did not include the organization
Yeah,
costs.
exactly.
said
Yes, this is what I have tried to explain here. That you see, in the previous question, the reorganization has not started. It would start if we take over, and the reorganization was purely to adjust to huge business. Okay, that was the thing. That was the name of the company was Huge and Small, I guess. So it was purely for mixing up with the parent company. Okay, but here this reorganization is underway. It is not something that will take place in future. The reorganization is underway, and the provision is to cover cost to be incurred in the next 6 months to complete the reorganization. Huge is acquiring, considering acquiring. So whether they acquire it or not, this reorganization has started and it will be completed. If it does so, the reorganization of Tiny will continue. If we quickly go back and see this reorganization, a provision required to cover the cost of reorganizing Jerry's departments to fit in with Tom's. So it was Tom and Jerry. So we had to do this reorganization so that it could fit in with Tom's structure. But there is no such thing in this question. This reorganization is not related to the takeover. It is already underway. I hope this makes sense now.
yes, sir. A lot.
Excellent.
Thank you. Yeah.
You're welcome. So we include that the reorganization provision, and we exclude the provision for trading losses. So moving on to the next question here, we have this theoretical one. So let's see. Which of the following adjustments are required when calculating goodwill on the acquisition of another company in accordance with IFRS 3 business combination? So what adjustments would be required while we are calculating goodwill on the acquisition of another company? So the first one, measurement of company's non-current assets at fair value where this exceeds carrying amount. So if there are certain items of the non-current assets which exceed the carrying amount, so this is regarded as a fair value adjustment. So we would include that. Okay. We're trying to calculate goodwill, and one of the item is there, which has the fair value of that item is higher than its carrying amount. Then we would consider it. The measurement of companies' inventories at fair value where this exceeds cost. Again, this is the same issue where the fair values are higher than the cost. So that would also be a fair value adjustment. Okay. So that would be made part of the goodwill. The recognition of a contingent liability if it is a present obligation of the acquired company. Yeah, there is this a contingent liability in the subsidiary company, and it's a present obligation. So we would also recognize that as a liability. So all the three items would be included in the goodwill calculation. So the answer would be D. I hope this was easy to understand.
Yes, sir.
Okay, excellent. So this one makes
Well,
sense.
this is all part of the things that are added when you're grouping, which are carried forward to when you're grouping things.
Exactly. And when you calculate for the goodwill.
Yeah, so we can say we include the assets, which is the parent assets and liabilities, and then the fair values and the adjustments of intangibles, which is what they're talking about here, the contingent liabilities.
Exactly. Yes.
Okay, all right, thank you.
Okay, so we continue with the next one here. That is, let me just clear the drawing so that we can have a better understanding. Okay, so this is a good one, however, not requiring a lot of calculations. At what amount will Mungo include the contingent consideration in its statement of financial position as at 31st of December 20x2? So we're looking at the value of the contingent consideration and at the statement of financial position date. So let's see what was the situation when the acquisition took place. Mungo acquired 80% of the equity share capital of Jerry on 1st of January 20x2, paying cash of 1.2 million. Mungo has agreed to make a further cash payment of 600,000 if Jerry's share price increase by at least 10% each year for the next 3 years. So they have agreed to make this consideration, which is contingent. If Jerry's share price keeps on increasing 10% every year for the next 3 years. So the fair value of the contingent consideration at the date of acquisition, that is 1st of January, was measured at 3,20,000. 3,20,000. So this is when we acquired the company. Okay, they paid cash of 600,000, and the contingent consideration had a value of 3,20,000. Okay. Now, what happened at the year end? At 31st of December 20x2, the fair value of the contingent consideration was measured to be 345,000. So this is the date for which we are required to calculate the value, and this is the answer. Okay, but there is a twist. But market expectations for the next 12 months are very poor, and the market as a whole is expected to fall by 15%. The market reacts as expected. Then the estimated fair value of the contingent consideration on the next year, 31st of December 2023, would be 180,000. Okay, but that is not at the year end date. That is at 31st of December 2023. So we're not concerned with that. We're only concerned with the date in question. So we will go with 3,45,000. We are going to put this value in the statement of financial position. And if there is any change, like initially it was 320, now it has gone to 345. So this is a loss that will be charged to the profit and loss, the difference of these two values. However, the question is only talking about the statement of financial position. So we're going to keep the value that was at that specific date, which is 3,45,000. Okay. So I hope this was straightforward. However, the question was twisted with a lot of information to confuse. Okay. But I've told you, you look at what is your date for which the question is asking. So that is your 3,45,000. So we take option B here. Is it clear? Yes, student. I hope it makes sense.
Yes, sir.
Okay, excellent. So we quickly move on to the next one here. Let's clear the drawings before we move on. Okay, so we have some more issues. We're moving at good pace since we're dealing with some theoretical ones. What effect will these issues have on the calculation of the goodwill? So we're looking at the calculation of goodwill arising on the acquisition of Sontoco in the consolidated financial statements of Ponto. So here the Sontoco is trying to take over Ponto. So let's see what are the issues. Ponto has acquired 100% of the equity share capital of Sonto on 1st of January 2027. A fair value exercise conducted. At this end, identified two issues. Number one, Sontoco owned the rights to a brand which it had developed internally. The fair value of the brand at 1st of January could be reliably measured. Okay, so this is something that we will be recognizing. Sonto has this right to a brand which they have internally developed. So when we buy it, we are going to consider this as the part of the value of the net assets. Okay, so what will happen due to this to the goodwill? This is what we need to understand. You see, when the fair value of the net assets increase, okay, and the amount that we have paid, for example, we have paid 100,000, and the value of the items before this were 50. So it was the goodwill would be 50. Okay, I hope you understand my example that the price that we are paying is 100 and the assets that we are acquiring are 50. So the goodwill would be 50, very simply. But now we know that we have this asset and the value of this asset is 10. So the fair value of the net assets or the value of the net assets becomes 60. It becomes higher. So what will happen to the goodwill? In this case, the goodwill is going to decrease because the value of the items that we are buying has increased. So that would result in a decrease in goodwill. I hope this one is clear. So for the first one, if we consider this as the asset of the subsidiary and we compare it with the cost of investment, so that would result in a decrease in goodwill. I hope this is clear. Or I could take this to the Excel sheet to explain.
It's clear.
Okay, excellent. Okay, the second issue is Sonto Co. has manufactured a bespoke and unique machine for a customer, and the sale contract stated Sonto Co. will provide any necessary repairs to the machine in the first 12 months after sale. Sonto Co. has determined that there is a 25% chance that the machine will require repairs during the period. Now here, we will have to create a provision, and that's a liability. So what will happen? If a liability arises, that is going to reduce the value of the net assets. Okay. The issue 2 will result in a liability being considered. So when the liabilities arise, the value of the net assets decrease, and when the value of the net assets decrease, the goodwill would increase as a result. So these two cases are different. Here we're talking about an asset, and here we're talking about a liability, a provision. So that would actually increase the goodwill. I hope it makes sense. The items that we are buying have decreased in value. So we are paying a higher price. The items that we are buying have a lesser value, which means that we are paying extra in excess. So the goodwill is likely to increase. Yes, students, does it make sense? So we choose these two. When the assets increase, it's a decrease, and when the other issue, that's increase. Yes, people, are we comfortable?
Sir, could you please show us in the
working?
Yes,
Yes.
please. I feel
Okay.
like I cannot get it. Like
Yeah, no problem.
Playing around with the equation. I'm not sure.
This is what I initially suggested, that it's not a difficult thing, but it becomes easier to understand when we do it with a certain calculation. It makes more sense. Let's see. So we have this issue that for the first one, there will be an increase in the value of the assets. So we have this issue 1. So we would say goodwill for issue 1 and after issue 1. Okay, so let's see how we can address this thing and understand. So we have this, I'm just going to give the examples: cost of investment and the value of the net assets, and we have the goodwill. This is a simple thing when there is no issue. The cost of investment is 100, the value of the net assets is 50, the goodwill is 50. Fine. Any problems with that? This is straight working. Now, the issue 1 has taken place. The cost of investment is the same, but the net assets have increased. Why? Because there is this internally generated brand, which we will recognize as an asset. So with that, the value of the assets increase and the goodwill decreases. The goodwill has actually gone down. Okay, the value of the assets, the fair value of the net assets has increased, and the goodwill goes down. From 50, it has become 40. Students, I hope you're comfortable with this one.
Yeah, it makes sense. Yeah, thank you.
Okay, so next one. If we look at the issue 2 here, we have the issue 2. So again, we will have the same situation, the cost of investment, which is again 100, and the net assets have this value, which is 50. So I will follow my same example. But now with issue 2, the cost of investment remains the same. But due to the liability, the value of the net assets has become down, because this time we have a liability. When the liabilities increase, the net assets decrease, and the goodwill increases. Okay, in this case, issue 2 is actually a liability. Issue 2 increases liability and decreases net assets, resulting in higher goodwill value. I hope this is clear now.
Yeah, sir. The point here is that in competing for the goodwill, under no circumstance did I think of a liability being part of goodwill. So as it came in here in the question, it made. I mean, I was thinking about no effect because liability all this while wasn't really a deal in competing for goodwill. It has always been the cost of investment less the net assets. And so that was where I got a bit confused.
Exactly. This is what they do. This is what they're good at, in making things difficult. Okay, so I hope we are comfortable now.
Yes, sir.
Yes,
Okay,
sir. Thank you.
excellent. So
I feel like
we
we're playing around with the net assets, because they increase it or decrease it, it affects in the end goodwill, because we are adding investment plus the other is it
yes,
the
you're right.
investment plus the other amounts we pay. If we
Yes.
less the assets, it gives us goodwill. So if we increase or decrease, it will impact this. So I feel like it's just an issue of the understanding the
Exactly.
formula to
Making
calculate it.
the right connections. Yes.
Yeah, okay.
Okay,
Thank
very
you.
good. Very good. So we move on to the next one. So here we have this, let's understand the question. What is the total amount that reduces consolidated retained earnings at 31st of December 25? So this adjustment relates to the consolidated retained earnings as a result of these consolidation adjustments. So let's see what are the adjustments here. On 1st of January 20x5, Pratt Co. acquired 80% of the equity shares of Samco. So this is at the start of the year, and we have to look at the retained earnings figures, and we have to see what is the amount that reduces the consolidated retained earnings. So Pratt Co. measured the non-controlling interest at fair value. Now this is very important. This means that if there is any goodwill impairment, it will be divided between the or there is any item that would be divided into the NCI and the controlling interest. So this is the 80%. So 20% is the NCI. So, and at the date of acquisition, the goodwill was measured at 20,000. So at 31st of December, the goodwill was fully impaired. So at the start, when we took over the company, there was goodwill, but at the year end, there is no goodwill. So we need to charge this goodwill to the retained earnings, and we're going to charge the 80%. Okay, do you agree? This is what we need to understand. We're going to charge the controlling interest, because this is only talking about the retained earnings. In conducting the fair value exercise on Samco's net assets on acquisition, Pratt Co. concluded that the property, plant, and equipment with the remaining useful life of 5 years had a fair value of 5,000 in excess of its carrying amount. So two things, that the useful life is 5 years and the fair value of the net assets is 5,000 in excess. So this means then there needs to be a depreciation. The depreciation is going to be 1,000, because we take the 5,000, we divide by 5 years, and the answer is 1. So overall, the retained earnings would go down by 21,000. Okay, but we have to calculate the value that relates to the controlling interest. Okay, so if I just take this question to the Excel sheet, we will have a better chance of understanding. So here we go. We have this situation. Let's clear the drawings here. Here we go. We have this impairment, goodwill. Goodwill impairment is 20,000. The depreciation for fair value adjustment. Fair value adjustment is going to be 1,000. That is fair value adjustment of 5,000 divided by 5 years. That is the answer. So the total value is 21,000, and the controlling interest would be 21,000 into 80%. That would fetch us the answer here. So the answer is 16,800. The consolidated retained earnings would go down by 16,800. You see, this is important to understand that this line has made a lot of difference. The measurement or the measured the non-controlling interest at fair value. Okay. I hope this is clear. The 20% of this fall would actually go to the NCI working. We're not adding 80%. We're actually taking 80% of it. We simply added the reductions. We had to reduce for the impairment of goodwill, and we have to reduce for the depreciation of the fair value adjustment. So overall, the reduction is 21,000. And yes, and because this fair value adjustment is related to the items of the subsidiary. Yeah, it belongs to the parent, but this fair value adjustment is related to the subsidiary. When we conducted the fair value adjustment for the net assets of the subsidiary company. I hope it makes sense now, since you're comfortable with the. Obviously, then there is no need to charge excess depreciation. The excess depreciation is only charged because of the fair value adjustment, because this is some value which is not included in the asset side. Exactly. Yes, you're right. Excellent. So I hope you're comfortable with this point. Actually, I'm actually responding to the messages in the group. Okay, I hope you people are all understanding what I'm responding to. I have the chat box. Okay, that's very good. Yeah, no problem. The impairment. Yeah, the goodwill impairment. The goodwill has been calculated for the controlling and for the non-controlling interest. So when the goodwill is impaired, what happens is we need to charge the portion of the goodwill that is impaired in terms of the controlling interest and the non-controlling interest. the 80% is charged to the retained earnings, and the 20% is charged to the NCI. Exactly. Obviously, then all of the goodwill would be charged to the retained earnings. I think we'll be looking at a question where this is the situation. Yes, I hope you're comfortable with this one. We can move on to the next one. Yeah, exactly. The same would go with the depreciation. Okay, so let's see. We have got the answer here. That is 16,800. Let me just clear the drawings here before we move on. Then 16,800. So we move on to the next one. This is correct. The next question is, yeah, this is a really good question. This is an interesting question. Okay, so let's see. Don't be overwhelmed by all the details. It's a simple one, but it has its own set of complications that we need to address. Let's see, we have this in respect of the current assets and current liabilities, what amount will be reported in Platco's consolidated statement of financial position as at 31st of October 20x8. So let's make this question simple. When it comes to the current assets and when it comes to the current liabilities, we simply need to add these two. That is the first simple step. The assets of the parent and the subsidiary are added. So once this point is done, then we can move on to the adjustments. Okay, so that is easy. When we make the consolidations, when we make the group accounts, the assets and the liabilities are added. That's the first part. Okay, so let's see. Okay, I've got a message here. Let me just check it first. Yes, I will take this to Excel, obviously. But let's discuss it here. Platco has owned 60% of the issued equity share capital of Serpico for many years. At 31st of October 2007, the individual statements of financial position include the following. Neither company had a bank overdraft at 31st of October 2007. Okay, so it shows that both the companies have good cash flow position and no companies keeping up bank overdraft. Okay, this is important to read. During the year ended 31st of October 2007, Platco made 100,000 sales on credit to Serpico. Serpico had 1/4 of these goods in inventory at 31st of October 2007. Platco makes a 20% gross profit margin. So this is one thing. This is the unrealized profit which we need to charge here. So we need to calculate this value and charge. Okay. So let's see. It's a good idea that we take this to the Excel straight away so that we could do the workings as we move along. So we will have to do this working for the. Okay. So here we go. This is the. Okay. Let me just squeeze it further. Okay, here we go. Now I think we'll be able to see most part of the question. So we have this, the unrealized profit. The unrealized profit is the value of the items is 100,000. And we take this 20% is the gross profit. And we multiply this to 1/4 since this many goods are there. So we calculate the value here. That is 100,000 into, that is 20,000. So 20,000 divided by 4, that is 5,000. Okay, so this is the unrealized profit, and this needs to be deducted from the value of the assets, because we're actually deducting it from the value of inventory. Okay, so we have this, let's write the value of the group current assets. The group current assets are, this is going to be, we add that is 1.2 million, and the group current liabilities. The group current liabilities are 500,000. Okay, so from here we take away this the unrealized profit, and we arrive at that figure. So this is one of the adjustments, because we have to get rid of the unrealized profit from the inventory, and the inventory is in the current asset. So this is one thing that we need to adjust. That's it, nothing more related to it. Moving on to the next one, on 1st of October 2007, we have this Serpico sent a check for 50,000 to pay all of the outstanding balance due to Platco, and Platco did not receive this check. Now this part is interesting. Okay, so you need to understand this much. Let me just underline it. I will read it again so that you understand that one of the company has to make a payment to the other company. The subsidiary company sent a check of 50,000 to pay the outstanding balance due. Okay, so the company that needs to make a payment has made the payment, and it means that they have updated their liabilities. So no need to update that. But the company that is the receiving company hasn't received the check. So if they haven't received the check, where is the balance? Okay, I will say the check paid is updated in the current liabilities as this company Serpico has reduced the payables. Okay, I hope this part is clear. They mention it. Serpico has sent the check, and they have paid all the outstanding balance, but the problem is with the owner, the Platco. So I'm not making any adjustment to the current liabilities. Okay, Platco has not received the check. The value is still showing as a receivable. Now the issue is both the cash and the receivables are current assets. Okay, this will not have any impact on the current asset. I hope this part is clear. That is one part for which we're not going to make any adjustment here, because the person or the company that has made the payment has already deducted it from the payables. On the other hand, the company that had to receive that check hasn't received the check and has kept it as a receivable. However, the receivables and the cash are both part of the current asset. So this is not going to make any impact. I hope this makes sense. So which means that this is the final answer. We take this figure, we sum it up, these two figures. So that is 1.195, and no change in the liability section. So that is 500,000. If they have given these figures in millions, so that would be 1.195, and that would be 0.5. Okay, so these figures are rounded. Let me just unround them to 3 decimal places. So this is the answer. So I hope this question is fine. You understand it? Yes. Okay, fine, no problem. I can explain it again. I hope you are comfortable with the unrealized profit part, the 5,000 that we have dealt with. Yeah, fine, that's good. So now coming to the next part, which is related to the payment. Do you agree that the current liabilities are updated? Because the payable, yeah, that's fine. So now the problem is with the current assets. And do you also agree that the cash and the receivables are both in current assets? Yes. So now where is this 50? Where is this? How much is the amount that has been paid? What is the value of the check? The value of the check is 50,000. The 50,000, since it's not paid, since it's not considered received, it is treated as a receivable in the accounts of the parent. Okay. So if it is later received, it will be considered cash. So we will be reducing the receivables and we're going to increase the cash. So will it have any impact? Something that is kept as a receivable right now, once the payment is received, it will be treated as a cash and the receivables will be reduced. Overall, the current assets remain unaffected. I hope it makes sense now. Yeah, we're talking about the group accounts. In the group accounts, the receivables of the company or the current assets of the group have this 50,000 as receivables. But when the cash is received, no, you need to understand there is current assets and current liabilities. It's not receivables or payables. Look at the requirement. It is current assets and current liabilities. It's not receivables or payables. Yeah, these were receivables and payables before, yes. Okay, you see we're talking about the current assets and current liabilities. Excellent, excellent. So we can move and check that the option D is the right answer. We go there and check this option D. That is correct. Okay. So, but it was a trick question, and we had to understand it properly. Okay, so students, we move on. Let's see if we have more challenging questions because we need a break here so that we could actually do the cash flows. Okay, so let's see. I think we can squeeze in another one and then see. Fine. Let's see. This is the question 9. And let's see the adjustments here. What is the journal entry required to reflect this fair value adjustment in the consolidated statement of financial position of BOTCO? Okay, so don't be scared of this question. It's a very easy one. Okay, you just need to understand the double entry and look at the dates properly. They want us to find the value on the statement of financial position date, that is 31st of December 2026. And BOTCO acquired 60% of Anchor Co on 1st of January 20x4. Now, how many years are involved here? Year 20x4, year 20x5, and year 20x6. So 3 years are involved here. Okay, year x4, x5, and x6. At the date of acquisition, the carrying amount of Anchor's net assets were same as their fair values, with the exception of an item of machinery which had a carrying amount of 90,000, a fair value, carrying amount of 90,000 and fair value of 160, which means that there was a difference of 70,000. The fair value adjustment is 70,000. Okay, so we could just write it here that the difference between the two is 70,000, and the remaining useful life of 5 years. So which means that there is this fair value adjustment, and for that we have to calculate the depreciation for 5 years, and whatever depreciation we get, we multiply that to 3 years, because 3 years have gone by from the date of acquisition to the financial statement date. Okay, so that is going to be the depreciation charge. So it's best if I take this question to the Excel sheet and we can discuss it better. So let's see. Okay, so let's see. So we have this the fair value. Fair value adjustment is 70,000. How have we calculated it? That the fair value has been 160 for an item that had a carrying amount of 90,000. That's a fair value. So, and there has been depreciation. Depreciation for we have this for 5 years, and we need to have it for 3 years. So let's see, 70,000 divided by 5, that is 14,000, and we take 14,000 into 3. This is the depreciation. Okay. So overall, the value of the goodwill will reduce. This is the same concept. You see this, since the fair value or the increase in the fair value will reduce the goodwill by 70,000. That's one thing. Fine. Then we are going to have this. So that is going to be, if we write the entries, we're going to debit the PPE by the value 70,000 less the depreciation, which is the 42,000. So the item that goes into the property, plant, and equipment is the difference of these two. That is 28,000. And then there is the other part, which is because we're going to charge this depreciation of 42,000 between the controlling interest and the non-controlling interest. So debit the NCI with this depreciation of 42,000 multiplied by the acquisition is 60%, so that is 40%. So we take this 42,000 into 0.4, that is NCI, and then we also debit the retained earnings by the same 42,000 multiplied by the 60%. So that is going to be 42,000 into 0.6. So this is what we have debited. So if we just see the impact of the debit value, that is 70,000, and we're going to have this one credit to the goodwill, which is 70. I hope this is clear, that we first of all had the fair value adjustment. This asset has a life of 5 years. The depreciation for 1 year is 14,000. For 3 years is 42,000. So we are going to have the value of the asset, that is 70,000 less 42, which we did here. And this decrease in the value of the asset would be charged to the retained earnings and to the NCI according to the ratio. So this is actually 42 into 40% and 42 into 60%. So this is the debit portion, and we're going to credit the goodwill. So this is how we deal with a double entry. And the correct option is A here. I hope this is clear. Yes, students, I hope this makes sense. This is the debit entry and this is the credit entry. This one is the credit. Yes, people, I need your feedback here. Does it all make sense?
We are processing.
Okay, okay, you can take your time. You can take your time. No, that is at the date of acquisition. The fair value, you see, this is when we acquired the company, the carrying amount of the anchor course net assets were the same, with the exception of an item of machinery. Okay. Yes, people, I hope we are making sense of it. If the net assets at acquisition increased in value, goodwill be reduced by the amount. Exactly. Yes, that's correct. So since the net assets have gone up by 70,000, net assets increased by 70,000, the goodwill will reduce. If the net assets will result in a decrease, an increase in net assets will result in a decrease in goodwill. It will require a credit entry in goodwill. Yes. Okay, so that's why the assets increased by 70 due to the fair value adjustment, and the goodwill is credited by 70. Okay. Yes, that's correct. No, it will be the same. The asset will increase by 70,000. However, the depreciation would be charged. So debit depreciation, a debit depreciation would be a decrease in the retained earnings. Okay, and in the NCI. So since we're not looking at the value at the end of 20x4, we're looking at the value at the end of 20x6. So by the year 20x6, 3 years depreciation has been charged, which means that the 3 years depreciation would be charged to the retained earnings and to the NCI in proportion of the holding. Nothing, there's no confusion with that. Very good. So I think this is clear now. Excellent, excellent. So students, I think we need to make a pause here. We have this one more area to attack, which is cash flow. Excellent. But I must say that you need to attack these questions again because you seem to understand them now. They need practice. You need to do the same questions again and again. Okay. An easy way would be to just open the ACCA hub site, and once you do these questions, you reset the questions and do them again. The more practice you do, the greater confidence level you will have. Okay, so this is the approach that you need to follow. So we are going to pause it here. We're going to take a short break of 10 minutes, and we're going to come back with cash flow. However, we haven't done all the questions. We have done 9 questions, and few questions are left. So I leave those questions to you. If you find any problem, you can let me know. Okay. So students, we are back and we are going to have an understanding of this the last area for the third day of the revision session, that is the statement of cash flows. So these questions are really good ones. Let's understand them and attack them. This is the first quiz for the statement of cash flows. So what amount should be presented in the statement of cash flows for the year ended 31st of December 2020? So we are only looking at the investing activities. Okay, so this is for the cash flow under the heading cash flow from investing activities. The year ended is 31st of December 2020. At 1st of January 2020, KC had property, plant, and equipment with a carrying amount of 2,50,000. In the year ended 31st of December 2020, company disposed of the asset with a carrying amount of 45,000 for 50,000. Okay, so and this is the company revalued a building from 75 to 100,000. So this is a revaluation of 25,000. Here we had this item that had a carrying amount of 45, which was sold for 50, and charged depreciation for the year of 20,000. At the end of the year, the carrying amount of the property, plant, and equipment was 270. Okay, so this is one of the question here. Let's see how we can attack this one, and we have to find out what should be presented in the cash flow for the year ended 31st of December 2020. So let's take this question to the Excel and understand. We're not looking at one aspect. We are looking at the whatever is going to come from investing activities, whether from the sale of the asset and from the purchase of the asset. So that is going to be a net value. That's why they say the outflows and inflows, these are the options available. So let's understand these ones. And in the meantime, I believe that the questions that are related to the practice questions related to this topic are more challenging. And anyhow, let's attack this one first, and then we can straight go to the practice questions. Okay, so let's see this one. Okay, so we have this first issue here. Let's just do these settings. Okay, so we have this. We have the opening carrying amount. The opening carrying amount, which is 2,50,000. And what happened during the year? We need to see that. That is the opening, and at the end of the year, that is at the first of and during and in the year ended, the company disposed of the asset. So whatever we disposed of, we deduct the disposal. We will deduct the carrying amount of the disposed asset, the carrying amount of the asset. So let's see the carrying amount of this asset, 45. Okay, so we take away the 45,000 here. Then we have this. There's a revaluation of 25,000. So we add the revaluation. The revaluation is by 25,000 here, and charge the depreciation. So we deduct the depreciation charge. The depreciation is by 20,000. At the end of the year, the carrying amount is 270. So first of all, let's see what is the value that we have, like what we have calculated. So the starting value was 250. We sold an asset, we revalued an asset, and we did the depreciation, and it's 210. Okay. However, the closing is a higher value, which is 2,70,000. So what is the difference? The difference is the cost of new asset. So how much is the new asset for? It is 60,000, because according to our calculation, the value should have been 2,10,000, but when we checked the value that was provided in the question, it was 270. So the difference between 210 and 270 is the 60,000 that we paid. So this is a negative cash flow. Okay. So, and we also have, okay, Yeah, we're not trying to calculate the cash flow here. We're just trying to see, because this is, I'm not making the cash flow statement. I'm just making the T account of the asset. I looked at the opening value of the asset, whatever I sold, I deducted it, whatever revalue took place, I added it. So that is the depreciation. So accordingly, I figured out that this should be the value, that is 210,000. However, the closing value is 270. So how come the value of the assets has increased? That is the cost of the new asset. So now I will be moving to the investing activities. So since the question is about the investing activities, so in the investing activities, I will write this cash paid to buy new asset. The cash that I've paid to buy the new asset is 60,000, which is a negative amount here. And then they tell us that the asset that I sold it for 50. So the cash received from sale of asset is 50,000. Overall, the net effect is net cash outflow. There's a net cash outflow of 10,000. That is the net figure that I have to calculate. So that is going to be the answer here. Okay. So I figured out I was not provided with what is the value of the new asset with the above working. I did that. And then I compared the two. What is the value of the new asset and what is the value that I received from sale of the asset? Because I sold this asset for 50, that had a carrying amount of 45,000. So overall, there is this net cash outflow of 10,000. That makes it option A to be the right answer. I hope this is clear. It was a straightforward one.
Yes, sir, clear.
Okay. So I would like few people to join me for this because I feel the practice questions are more challenging here. So I will just pause this one here and would like to move to the practice questions relating to this topic because they are more challenging. And they also have the theoretical aspect, which usually creates trouble for the students. So let's see how we can. You see, there are a lot of numbers involved. Okay, this is the other one. This is the section C style. Let me look at this is the OT. This is the these are the questions. Okay, so let's see how we can attempt this one. So let's see. Which of the following items would be included under the heading cash flow from operating activities? So you see when you look at the cash flow statement, the most tricky part is the cash flow from operating activities. It sums up to around 55% of the cash flow statement. Okay, so they want us to find or they want us to identify the items that go in the operating activities. The IAS 7 statement of cash flows sets out three main headings to be used in statement of cash flows. And can you figure out which one is related to the operating activities? Is it the interest? It is the income taxes paid, purchase of investments, dividends paid, purchase of equipment. Yes. Will anyone have a go at it? Okay, I've already got one response, two responses.
Income taxes paid.
Exactly. The answer is A. Because we're talking about the cash flow from operating activities, I also have received a D option, which is related to the investing activities. When we purchase an equipment, we post it to the investing. So the answer is A. Very good. So we can stick this one here. That's the first one. So let's clear the drawings before we move on. Okay, so the next question here, this is a good one where we have to see the treatments of various things. So we have this identify by clicking on the relevant box in the table below, whether each of the following criticisms of this extract is correct. So what is the extract? We have this information where we have the operating profit, we adjust. This is the cash flow statement made by a trainee accountant. So let's see what the trainee has done. So the trainee has actually, the depreciation has been deducted, it should be added. So this is something wrong. We need to add back the depreciation. When it comes to decrease in inventories, a decrease in inventory is a positive thing. So that is okay. That has been rightly added. Increase in receivables, it's a negative. That is also correct. An increase in payables, when the payables increase, it's a positive thing. Now this is not correct. So it's a positive thing. We do not deduct it. Okay? And that's about it. So let's see. According to this question, let's look at the options here. So the first one that we have is, we could just choose here, depreciation charges should have been added. Now that is correct. Depreciation charges should have been added. The decrease in inventories should have been deducted. Now that is correct. When the inventories decrease, that means the cash is released, because from the sale of the inventory is only decreased when it is sold. So the cash should come up. So that's a positive thing. So that's incorrect. Decrease in inventory should be added. They say it's deducted. Increase in receivables should have been added. Yeah, when the receivables increase, that's a negative thing. We do not get money. So that is also incorrect. Increase in receivables should be deducted. Okay, so that is incorrect. The last one, increase in payables should have been added. Now that is correct. When the payables increase, that's a positive thing because we are not paying them. So these are the four options. And these are the four criticisms, and we picked up the right ones according to the understanding for the operating activities. Okay, so we have already discussed it here, and now we are moving on. So the next one, let me just clear. Yes, students, I hope we are going fine. Okay, so this is another one that is related to the non-current assets. Let's look at the requirement. What amount would be shown in Ealing's statement of cash flows for purchase of property, plant, and equipment for this year? So let's see. We only want to see the value for the purchase of the property. The property, plant, and equipment of Ealing were as follows. It had a cost in the start, it had a cost at the end, and what happened during the year? During the year, an item of plant which had cost 80 and had a carrying amount of 30 was sold for 20. So that's about it. They have given us this much information that at the start it was 180,000. So, and we sold one of the asset that had a value of 80. So if we take away the 80 from here,
doing a mock revision of that exam that I'm writing in next September. Look at the time
is there a question here? Okay, so the answer is 100 here. The value of the assets would be 100. Okay, so we take the difference of 100 and 140. We calculated the value of the assets as 100. However, the closing value is 240, which means the assets have increased by 140. Okay, we have calculated a value and they have provided us the values. So accordingly, we think that the value of the asset should be 100. However, the value of the assets had gone up to 240. So let's see, what could be the value of the purchase of the asset? That would be 140. So that is the right option. So I hope, I hope this is clear. It was a straightforward one, but it was an important one to calculate only the value of the asset. Okay. That's good, yes. Okay, fine, no problem. We can do this thing for the next one, okay? I did this one, I saw your message late. So let's see, let's move on to the next one. Let me just clear, okay. Okay, this is, let's look at the requirement. Which amounts are included in the reconciliation of operating profit to net cash flow from operating activities? So you have these two items on comparing the components of net assets of DEEP on 31st of December 20x2 and 31st of December 20x1. The following movements were noted. So we only have to see what items would be included in the operating profit while calculating the cash flow from operating activities. The first one is a decrease in the warranty provision due to change in estimate, and the other one is the increase in property, plant, and equipment of 98,000 due to revaluation in the year. Yes, which values would you include in the cash flow from operating activities? Yes, this is, I'm going to give you this chance. Yes, people, what is the right answer? Okay, I've got one response.
One.
Exactly, one only. Very good. This is, the answer is A. Very good. That is not A, rather, it's one only. That is B, which is, yes, so we will go with B. Because the other one relates to the non-current assets that would be, that would not feature really in the statement of cash flows. So that is the right answer. Moving on to the next one here. We have this, let's see, let's clear the drawings first. Okay, in accordance with IAS 7 cash statement of cash flows, what is the cash flow from interest paid for the year ended 31st of for the year ended 30th of September 2021? So let's see. This is a good one. We have this. Yeah, you people need to be careful about this one. It's a good question. We have to find out the interest paid. Okay, so interest paid that goes to the cash flow. So on 1st of October 2020, BK had an accrued interest payable. So this is the opening accrued interest liability. Like this is what we owe them in the start. The interest expense for the year ended 30th of September 2021 in the statement of profit and loss was 41,000. Now this is important. This is the total interest for the year, and the accrued interest at 30th of September was 15,000. Okay. Now the interest expense. Now we're talking about this interest expense. This interest expense that we have just seen. We're talking about this 41,000. Now what does this include? Included interest on borrowings. Okay. And an unwinding of the discount on commissioning provision of 5,000, and the interest element of repayment of the lease liability. So here we have this unwinding of the discount on the decommissioning. This is an interest cost, but that is not related to cash flow. There is no change in cash flow due to this amount. Okay. However, for a lease liability, we have this interest, and this is related to cash. Okay, but when it comes to the decommissioning provision, and this is the unwinding. You see, you wind the decommissioning cost. You take the present value, and as the time progresses, you unwind it. So this is not related to cash flow, but this is included in this 41,000. I hope you understand one thing, that the unwinding related to the decommissioning is not related to cash, but it is charged here. It is part of this thing. So we need to reduce this interest expense. This interest expense should be 36,000 if we take away this 5,000. Okay. So I hope this point is clear. And if you understand this point, then we can easily understand this question. Both the interest payments are included in the 41,000. So if we take this one here. So we have this.
Excuse me, sir. So even the 3,000, we shouldn't include it?
Yeah, this 3,000 is related to the lease payment. This should be included because you see,
Okay.
yeah, we make a lease payment. The interest that is related to the lease payment is actually paid. Okay. So we
should include 3,000. So
it is
the
it
difference
is already
between 5
included.
and 3.
Both the values are already included in this 41,000. Okay. So we have
Okay. But
opening.
even shouldn't like we only subtract the difference between 5 and 3?
No, let me explain. Let me just write the
Okay.
whole thing. That initially we owe them 12,000, and the interest expense is 41,000. However, it should not have the 5,000. Okay, that relates to this amount. So if we take away this one, this 41,000 less 5,000, the answer is 36,000. So the interest expense should really be 36,000 that we added here, because this 5,000 belongs to this 5,000 is the part of 41,000, and this 3,000 is also part of this one, because they say the interest expense included interest on borrowings and unwinding of the discount on decommissioning provision of 5,000. Okay, so we take that away, and we figured out that the total due is, we add these two values, and we say that is the total value due, which is 48,000. Okay, I'm already receiving the responses. Let me just, yes, you got the right answer. Very good. Okay, so this is 48,000. That is the total due. However, the closing liability for interest is only 15,000. So we think it should be 48. However, it is 15. So what is the amount of cash? The difference is cash paid. The cash paid is the difference of these two things. So we take this 48, we deduct the 15, and we have the answer as 33,000. So this is the answer. So from here, we figure out what is total due. And from here, we figure out what is the amount of the cash that has been paid. This is 33,000. So I hope this makes sense. This was just made tricky because of this wording that 41,000 included these two. However, it should not have included this 5,000. Okay. So the answer is 33. Let's go back and mark the right one here. It is 33,000. Let's clear the drawings. So that is correct. This is 33,000. Moving on to the next one here. Let's see what challenge this poses for us. However, this is also similar to the non-current assets. Mostly you will be tested on this. What amount would be shown in Fry's statement of cash flows for purchase of property, plant, and equipment for the year ended 30th of September 2024? So this is the date, and for which we have to write for the purchase, for how much we bought this new PPE. So let's see what is the information at the start that we have, and then we can understand. So what do we have? In the start, we had this, let's clear the drawing. So we had the following information is available for the property, plant, and equipment of Fry. We have the carrying amounts. The opening carrying amount is 14,400 and the closing is 23,400. There is this depreciation charge. These are the following items were recorded during this year ended 30th of September 2024. There is this depreciation charge. We will deduct it. An item that had a carrying amount of 3 million was sold for 1.8 million. We're going to consider the important values. We will be deducting this depreciation. We will be deducting the carrying amount since we are provided with the carrying amounts. The upward revaluation would be added. There is this environmental provision relating to this were capitalized. So this is going to be added. Okay. So this would increase the value of the assets. So this one would be deducted. This one would be deducted since it is sold. This one would be added. And this one would also be added so that we could have the right value of the asset. And then we will take the difference with 23.4. Okay, I think you people have already done it. Okay, you've got the answer A. Yeah, I believe that's the right answer. But let's see, the others haven't attempted it. But you people have got it right. Very good. So let's take this one to the Excel sheet and understand. Fine. So this opening is 14,400, or let's talk it in millions, 14.4. Let's unround these figures. These are rounded to one decimal. Okay, so this is opening. There is depreciation that would be deducted as 2.5. Then there's the disposal, and that is less 3. And then there is this revaluation. The revaluation is 2. And then there is this the environmental provision. The provision is added 4. So according to these calculations, we have a balance which is 14.9. However, the closing is they have provided 23.4. So we take the difference. Difference is the new cash, new plant, or the new PPE. So let's take the difference between these two. This figure minus this. So the answer here is 8.5. So this is, you people have already calculated this answer. That's very good. So students, these were the questions related to the cash flow. So we conclude the session here. I hope you people have understood these concepts, the related to interpretations, consolidation adjustments, and the cash flow. So we conclude this this marathon session of 3 days that had revision of some important topics. I hope you people have benefited from it. I've left some questions which you should attempt, and you should also attempt the questions that we have done, so that you could have a better understanding. Okay. So students, that is all for the day.
So on the
Thank you, sir.
this question,
You're welcome.
on the revaluation, it's 2. I don't understand why we're adding it.
Revaluation.
Yeah, the 2 for the revaluation surplus.
Yeah, basically, we are only trying to calculate what is the value of asset that we should have, and then we compare it. What is the value that is at the year end? We found out that according to these adjustments, the assets should have a value of 14.9. But when we look at the closing balance, we see that the closing balance has increased, and we figure out that the closing balance is only increased because there must have been a new property, plant, and equipment. And this is what is required in the question. So we put in all the details that we know: the opening balance, the depreciation charge, the disposal amount, the value by which the asset has been revalued and it has increased, and some more provision that has been created. And we figured out it should be 14.9, but when we look at the closing value, it is a higher value. Okay.
Mm.
I hope it makes sense now.
Yeah, it makes sense.
Okay. Actually, we have I have dedicated the next 3 days for my taxation. I will have to give a schedule to those students. In the meantime, if you people have any questions related to these questions, you can let me know. I hope you people are with us in Vertex. We have this WhatsApp group and the WhatsApp support. So that's good. Then you can attempt those questions and you can let me know if you have any confusions. Okay. So students, it was yes.
So it has nothing to do with cash flow, but is it possible for you to show us a pro forma of IFRS 18 with the
Yes,
the new income statement?
We have already uploaded the questions related to the IFRS 18. Do you have access to the ACCA site?
Yes, I do. Yeah.
The ACCA people have updated the questions and the performer. However, I can also show you the performer related to the changes. Here you go. This is the perform. I have done some question practice related to, this is the pro forma for the statement of, yeah. So you see, we have the revenue, cost of sales, gross profit, selling expenses is new thing, general and administrative expenses, then you have the operating profit. So this is the new updated format. And then we have this, yeah, if you could have this here. Yes, this is the new format. You could take a snapshot. Profit before financing and income taxes. Then there is this interest expenses on borrowings, profit before income taxes, income tax expense, profit for the year, and other comprehensive income. This is the latest pro forma for the statement of profit and loss.
Thank you, sir. Yes, sir. Thank you.
You're welcome. Okay, so we have this. Yes, someone has also shared that for you to understand. However, we have done a section C style question, and we have also done the quizzes and the practice questions, which are available on site for IFRS 18. Okay.
Yes, yeah, I remember. Yeah.
Excellent. So students, that is all for the day. It was a pleasure having you people, and I pray that all of you people do well in the exam. There is still plenty of time before the exam, so you should use that time effectively for the preparation. And we are available for your help if you need any guidance. If you are confused in any questions, we will be there to help you out. Okay. So all the best. My prayers are with you, and I will be supporting you.
Thank you, sir.
Yes.
Is this our last class? We're not meeting tomorrow.
No, we're not, because we had planned this for 3 years, for 3 days. I have a 3-day session for my other taxation students as well. Okay.
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 Thank
So
you,
take good care, people. And I want you all to score really high in this exam, because you can actually do that if you do enough practice. So students,
So
good luck.
I feel like I'm not ready at all with those big section C questions. Do you have any advice on how I can start the question and get confidence?
Well, I must say that the first thing that you need to do for section C is that you pick a section C question that has been solved on site. For example, you can take the IFRS 18 question, for example. This will help you, good idea of how to deal with the format. You do that question, you do that once, you do that twice, and you do that 3 times. This will help you master the technique and get the confidence related to it. Okay. This is the only thing. The practice makes you. You do not do a lot of questions, but you do few questions, but you do them like 2 to 3 times. This will give you confidence. And when you do them on Excel, this will give you practice as well. So don't try to do a lot of questions, but the few questions that you do them at least 3 times.
Okay.
You will see that you will start feeling the confidence.
All right. Thank you.
You're welcome. Take good care, people. This was all for the day.